So we've looked at our variable cost variances. We can do that bit. What we now want to do is to look at our fixed cost variances. And as I've said, fixed costs are different. We expect variable costs to vary proportionately with output. And that's the reason why we flex the budget. Do you remember we talked about standard hours and standard quantity relating to the actual output? Of course, with fixed costs, it's the other way around. We expect fixed costs to be fixed. So when we deal with our fixed overhead variances, the first thing we have to consider is this. When we look at our variances, are we considering them under an absorption cost in question or a marginal cost in question? If we were looking at absorption costing, what do we do with the fixed costs? Well, of course, you know this. What we do is we attach the fixed costs to the product. We value the product in full cost terms. Therefore, they are linked to the product. And if they're linked to the product in some way, we have exactly the same issue that we had before. Do you remember talking about absorption costing? We discussed the idea of under-over absorption. Well, in essence, when we look at our fixed overhead variances, it's exactly the same idea, although you may not see it. When we look at marginal costing, they are not linked to the product. And if that's the case, life is far, far easier. What I'm going to do is to give you a pro forma. I'm going to tell you how you do it. I don't really care about the reasons why, because if we get into the reasons why, it becomes complicated really rather quickly. So let's just go away and, yes, we're looking at absorption costing principles first of all. And again, all I'm going to do is to give you a pro forma. Remember, I want you to know what, and I don't necessarily want you to think about why when you're doing the numbers. We've got to get these numbers out quickly, and to get the numbers out quickly, focus on getting the numbers into the pro forma, bashing out the variance, and deciding whether it is adverse or favourable. To do that, we start with our standard hours, standard rate. Secondly, we have our actual hours, standard rate. Thirdly, budgeted hours, standard rate. And 4, actual hours, actual rate. If we remember this pro forma, we can do any question. And that's what I'm interested in. If you delve too much into the theory behind it, you will worry about what you're doing. And I don't want you to worry. I want you to get the numbers out, 2 marks, job done, move on to the next question. Now, we do have an issue here. If we're just looking at the pro forma, we've got something called standard hours and we've got something called budgeted hours. And for a lot of people, this is a bit of a concern. What's the difference between the standard measure and the budgeted measure? Well, if you remember at the beginning of variances or standard costing, I said that the standard is per unit, whereas the budget is in total. But this doesn't really work here because the standard hour measure that we have here will also be a total value. So let's just go away for a moment and discuss what they mean. When we look at standard hours, what we're looking at here are the expected hours of the actual output. if you think about it, we've used this a number of times already, because when we looked at standard hours with labour or variable overheads, that's precisely what we did. Some of you may want to think of it this way. We have flexed the budget, because what we've done here is we have taken the standard efficiency, but we're looking at it at the actual level of activity. When we look at our budgeted hours, we're looking at the expected hours of the budgeted output. Please remember the distinction. This is a vitally important distinction now and in your future studies. If you can get it there, hardwired into the system, you're sorted. Can I tell you, for a lot of students, they never establish the distinction between these two. So get it into your brain and you're sorted. You're well ahead of the next guy. So, we've looked at standard hours and actual hours. We've looked at budgeted hours. Now, let's introduce some numbers to what we already know. If you remember with our fixed overheads, we originally talked about the standards. 2 hours per unit multiplied by £8 per hour, and that gives us £16. Remember, because of the fixed nature of the cost, I want also to know the budgeted level of activity. The budgeted output, let's just say, was 1,000 units. And once we've got those, now we just have to look at the other bits and pieces. If we're looking at our actuals, we know that the actual output was 1,400. We're using the same example throughout. If we want to look at our actual fixed overhead, what are we given? Well, first of all, we have to look at the actual hours. And remember, we would expect those actual hours to come from labour. They don't have to. But if you think back to the example we've done, we've already got actual labour hours of 3,000, and I want to keep them. Given that we have that, all we have to do is to establish the actual fixed overhead cost. And the actual fixed overhead cost is 15,000. Right. Shall we see if we can bang these numbers into our pro forma? Let's see what we can do. Shall we start at the bottom? Keep it nice and simple. Do we know the actual hours, actual rate? Well, if you remember, actual hours multiplied by the actual rate will give us the total actual cost. And I think we have that already, £15,000. When we look at budgeted hours at the standard rate, well, hold on a moment. What we're trying to do is to understand the overall budgeted cost. Now, often we're given the budgeted cost as a single figure. But when we look at this particular question, we have to go hunting for it. The budgeted hours were at the budgeted level of activity. We expect each unit to take 2 hours. And we budgeted to produce 1,000 units. And the standard rate was 8. 2 times 1,000 times 8 comes to 16,000. Then we need our actual hours. Actual hours at standard rate. The actual hours were 3,000. The standard rate was 8. Wow. So we worked far more hours than we originally budgeted. An interesting point here, is that good or bad? Well, we'll come back and talk about it in a moment. 24,000. And finally, we want our standard hours. Now, we've seen these again and again and again. Standard hours is short for the standard hours of actual output or production. We know that the actual output or production is 1,400. So we've established our standard hours. We can multiply by the standard rate, and what do we get? 2,800 multiplied by 8. What's that? 22,400? So we have all the values. What variances can we calculate from these? Well, let's go through them bit by bit. If we look at the first two elements, standard hours, standard rate, actual hours, standard rate, we've seen those before somewhere, haven't we? You may remember that those two elements make up the efficiency variance. That's not difficult at all. The next variance is where we compare actual hours standard rate to budgeted hours standard rate. We're going to learn to call this the capacity variance. And finally, comparing our budgeted cost to our actual cost gives us the expenditure variance. Now, let's do the calculation. Top minus bottom, the difference is 1,600. Is that good or bad? Well, it's negative, therefore it's adverse. Top minus bottom, the difference is, wow, 8,000. Is that good or bad? Well, it's positive, therefore favourable. Top minus bottom, the difference, 1,000. Positive, favourable. Well, we already know what an efficiency variance is all about. We're looking at how well we worked our hours. Our actual output was expected to take 2,800 hours. We actually worked 3,000 hours. If we worked more hours than expected, that's bad news. But let's just dwell on the capacity variance for a moment. We budgeted 2,000 hours, but we actually worked 3,000. Is that good or is that bad? Well, remember the fixed nature of the cost. I don't know if you remember back to under-over absorption, but one of the aspects of under-over absorption was the amount of overhead absorbed. What we're seeing here is that we're working more hours than we budgeted. If we work more hours than budgeted, all else being equal, we will absorb more overhead. So when we look at the capacity variance, if the actual hours are higher than the budgeted hours, like here, that is a good thing. Because actual hours worked means more absorbed. More absorbed will lead, all else being equal, to an over-absorption. Therefore, that's the reason why it's favourable. My view is that you don't get worried about that at all. If you adopt our very simple idea of top minus bottom, positive being favourable, negative being adverse, you get your numbers out without having to think. And remember, thinking is bad here. I want you to be thoughtless. Finally, we have our expenditure variance. Notice, when we look at expenditure, all we have compared is our budgeted cost, the original budget, against the actual cost. And that's because we're reflecting the fact that we do not expect the fixed overhead to change. It is fixed. I think we need a little bit more practice with our fixed overheads. Let's play around with other numbers. If I were to give you these sort of numbers, we've got a budgeted lot of information and an actual lot of information. I'm going to give you budgeted units, budgeted hours, and budgeted cost. Budgeted units are 1,000. Budgeted hours are 2,000, and budgeted cost is 10,000. And then we have the actuals. Actual units are 1,100, actual hours 2,300, and actual cost 11,000. From those 6 pieces of information, we can now do our fixed overhead variances. So before we do anything else, shall we get the pro forma down and see what's what? Standard hours, standard rate. Actual hours, standard rate. Budgeted hours, standard rate. And actual hours, actual rate. So we've got the components down. We know if we compare the first two, we get the, yes, the efficiency variance. What about the next two? Yes, the capacity variance. And the final two? Well, yes, that's the expenditure. So we've banged down our pro forma, and all we have to do is to slot information into that pro forma. Well, okay, let's go back to the information and see the sort of thing that we need to get out of the information. Remember what I've said to you before. I said that the standards are closely linked to the budget. The budget is in total and the standards are per unit. So, if we were to look at the budgeted units and the budgeted hours, what piece of information could we pick out? Well, yes. Couldn't we say that the standard efficiency is 2 hours per unit? And if we were to look at the hours and the cost, what could we also identify? Well, yes, we could get our standard fixed overhead absorption rate. 10,000 divided by 2, £5 per hour. I suppose if you want to, you could get the cost per unit. 10,000 divided by 1, £10 per unit. So these are the sorts of pieces of information that we need. And the link between budget and standard is so critical. If you can understand that link, you're absolutely sorted. So let's go for it. Remember, when I prepare these, I always tend to start at the bottom because the numbers tend to be easier. Actual hours, actual rate. Do we know that? Well, actual hours multiplied by actual rate will give us the total actual cost. And if we look at the information above, aren't we given the total actual cost here of 11,000? Not too difficult. So we just slot that in there. Next one up. Budgeted hours, standard rate. Now, if you remember, we talked about this before. I said if you took the budgeted hours at the standard rate, you would get the budgeted cost. Do we have that? Well, let's look back at the information. I've got a sneaking suspicion that that is the budgeted cost. Great. We have two elements, and I don't know about you, but I'm not even breaking into sweat. So let's slot that one in there. 10,000. Now we're going to have to do a little bit more hunting. What about the actual hours and the standard rate? Do we have those anywhere? Actual hours. Oh, don't we have them here? And if we look at the standard rate, isn't it this little chappy here? So, 5 multiplied by 2,300. What do you think? Does that make some sort of sense? I hope so. So we said the actual hours were 2,300 and the standard rate was 5. What's that? 11,500? Finally, we need the standard hours. When I say standard hours to you, what do I mean? I mean the standard hours of actual output. Well, okay. If we look back, what are we given? Well, we're given the standard hours, 2 hours per unit. We're given the actual output, 1,100. We have all the information that we need. Two hours per unit multiplied by 1,100 units multiplied by the standard rate, which we already have, 5. What does this come to? Rather nicely, it comes to 11,000. We pop the numbers in. Once we've got the numbers in, calculating the variances is very easy. Top minus bottom, 500, adverse. Top minus bottom, 1,500, favourable. Top minus bottom, 1,000, adverse. Job done. So, use the pro forma and you can easily score marks here. Well, okay, what we've managed to do is to look at all of the cost variances under absorption costing principles. Let's just think about this for a moment. How would things change under marginal costing? Well, if we're looking at marginal costing, the only difference between the treatment of absorption and marginal is down to the fixed costs. So if we go away from here for a moment, and we decided to apply marginal costing, what's going to be the difference? What remains the same? What's going to be the same and what's going to be different under marginal costing? Well, let's consider those things that remain the same. Remember, the treatment of variable costs under both absorption and marginal costing is the same. So all our variable cost variances will not change. What about things that differ? Well, the difference is obviously going to be related in some way to our fixed overhead variances. Let's just go back to the previous example and see how things may differ. If we look at the previous example, we have 3 variances. Well, let's start at the bottom. First of all, we have an expenditure variance. Well, the deal with the expenditure variance is this. Regardless of whether you use absorption or marginal costing, you must spend the money. So from that perspective, the expenditure part will still exist in marginal costing. However, when we look at the other 2 components, these relate to volume. These relate to whether we have produced more or less units. If you want to refer back to the idea of absorption costing, these relate to absorption. Now, when we come to look at marginal costing, do we try to absorb the fixed cost to the product? Well, the answer is no. And as such, when we look at these, the volume, hence the efficiency and capacity variances, they will not be calculated in marginal costing. So, taking those 2 pieces of knowledge, we know that the fixed overhead expenditure variance will remain. Because you must spend the money, and there will always be a difference between the actual amount and the budgeted amount. The difference is that when we look at fixed overhead volume, which of course includes efficiency and capacity, these all relate to the absorption of the fixed cost to the product. Something we do in absorption costing, but something we don't do when we're looking at marginal costing. Well, that's a great thing. It means that the fixed overhead volume variance disappears. We don't have to worry about it. And if that disappears, the efficiency and capacity variances disappear as well. I don't know about you, but it makes life an awful lot easier. In essence, all we're left with is this. What we're suggesting is that we get rid of that area there, and we're only left with the expenditure variance. I don't know what you're thinking about this, but my view is this. The expenditure variance is by far the easiest one to calculate, because all we're comparing is budgeted cost to actual cost. Job done. So, we've managed to look at all the cost variances. What we're now going to do is to go away and look at the sales variances, the revenue side. Now, unfortunately, there is no easy pro forma I can give you for sales variances. So instead, what we're going to have to focus on here is using basic formulae. Now, there are two sales variances that we need to know. We need to know a volume variance and a price variance. The volume variance is whether we sell more or less units than we budgeted to sell. The price variance is whether we set a price that is higher or lower than we originally established as our standard. So our volume variance, this is something that you learn. Actual sales minus budgeted sales, multiplied by? Well, we have to be careful here. You see, again, we've got to make a distinction between absorption and marginal costing. First of all, we're going to start with absorption costing. In absorption costing, we've said that we value the product in full cost terms. So if we were to compare the full cost to the selling price, the difference between the two would be a profit margin. Therefore, we multiply by the standard profit margin. To calculate the price variance, we take the actual price minus the standard price, and we multiply by the actual sales. So shall we throw together a few numbers just for fun? Let's look at the outputs first of all. I suppose we're talking about sales here. Our budgeted sales are 1,000 units. Our actual sales are 1,400 units. If you remember from the studies that we had before, remember the numbers that we calculated? We said that the standard variable cost was £32 per unit. And we said that the standard full cost, poor way to write it, I think, full cost was £48 per unit. If I now tell you that the standard selling price was £70 per unit, and the actual selling price was £65 per unit, I think we have sufficient information. Right. Remember what I said. When we're looking at the volume variance, what we want to do is to look at the difference between our cost base, in this case, £48, and the price at which we expect to sell, £70. So what we've identified here is this. The difference between the cost base, 48, and the standard selling price, 70, is £22. That would be our standard profit margin. The reason why we do this is because we've already reconciled all of our cost variances. So when we look at our sales variances, we're going to reconcile from that standard cost to the selling price, not the full amount. Well, okay, how does this all pan out? If you look back at the information, we said the actual sales were 1,400. The budgeted sales were 1,000. We multiplied by the standard profit margin of 22. And that gives us £8,800. Is that good or bad? Well, intuitively, I think we know it is good. But again, my formula are set up. So if it's positive, it's favourable. If it's negative, it's adverse. This is good news. We've sold more than we expected to sell. Now let's look at the price variance. What was the actual price? I think we said it was 65, didn't we? And the standard price was 70. We multiply by the actual sales, 1,400, and what do we get? 7,000 adverse. If we were to look at possible reasons, what could we say? Well, the only thing we tend to pick up on about possible reasons with our sales variances is this. We would expect an inverse relationship between price and volume. If we push the price up, we would expect maybe the volume to fall. If we drop the price, maybe we would expect the volume to rise. And I think that's what we've seen here. The selling price has fallen by £5. The volume has gone up by 400 units. It looks like it's been a good thing for us to do, although, of course, there could be other external aspects that we don't know about. So, we've looked at our volume variances, our sales volume variance, based on absorption costing. But some of you may have noticed that when I gave you the information, I didn't just give you the total cost. Some of you may notice that we've also talked about the standard variable cost. If we were talking about marginal costing, what do we value the product at when we're looking at marginal costing? Well, if you remember, we only value the product under marginal costing in variable cost terms. And as such, if we're looking at marginal costing principles here, we have to revise the sales volume variance. Let's just think about it. If we look at the sales volume variance, under marginal costing, we would look at the same actual sales minus the same budgeted sales. However, what margin will we earn under marginal costing? Well, if you remember, under marginal costing, we value the product at variable cost. The difference between the selling price and the variable cost gives us our standard contribution margin. That's the big difference. That's the only thing we have to learn with regard to marginal costing when we're looking at variances. If we look back at the numbers, If we look back at the numbers, we have our standard variable cost and our standard selling price. The difference between the standard variable cost and the standard selling price is £38. That is what we would use. Now, in a moment, we'll discuss how this all comes together. But let's just get the numbers out of the way before we do anything else. We said our actual sales were 1,400. Our budgeted sales were 1,000. The standard contribution margin was 38. Therefore, we end up with 15,200 as our variance. Is that good or bad? Well, I think it's favourable. It's favourable because it's positive, and that's the deal we always play with. Okay. So what have we got here? Well, let's just go back and complete our analysis of marginal costing. We've said that variable cost variances will be the same under both absorption and marginal. We've also said that the fixed overhead expenditure will be the same under absorption and marginal. And we've said that because we're not absorbing our overhead, we don't need fixed overhead expenditure or fixed overhead capacity. They disappear. What can we say about sales? Well, the selling price variance doesn't change. That's just the difference between actual and standard price. The only thing that changes is how we value our sales volume variance. So what we can say here is that the sales volume variance is valued at standard contribution margin. Now, if you were to delve deeper, if you were to look at this more seriously, you would identify that effectively one compensates for the other. The volume variance that we had in fixed overheads now transfers, so it's all in the sales variances. But please don't worry about it. That is not an issue. The simple issue is, can you calculate the variances? Can you do them quickly and accurately? Beyond that, I really don't care. And the reason why I don't care is because your examiner doesn't care. So now why don't we look at recapping what we've just learned? If we recap, let's start with our variable cost variances. And to do that, shall we look at materials? But of course, the same would hold true for both labour and variable overheads. All we need to know is a pro forma and how to slot the information into the pro forma. We know standard quantity, standard price, actual quantity, standard price, actual quantity, actual price. And please remember, when we talk about standard quantity, what do we mean? We mean standard quantity of actual output. If we compare the first two, we get the usage or quantity variance. We compare the latter two, we get the price variance. Then we can look at our fixed overheads. Again, it is pro forma led. Standard hours, standard rate. Actual hours, standard rate. Budgeted hours, standard rate. And actual hours, actual rate. If that's the case, when we compare each and every one, standard hours, standard rate to actual hours, standard rate gives us the expenditure variance. Actual hours, standard rate to budgeted hours, standard rate gives us the capacity variance. And budgeted hours to actual hours will give us the expenditure variance. Please remember, when we look at standard hours, what do we mean? Well, we mean the expected hours of the actual level of activity. And when we look at budgeted hours, what do we mean? Well, we mean the expected hours of the budgeted level of activity. If we remember those two elements, we will have no problem. Now, for all of these variances, top minus bottom, if it's positive, it's favourable. If it's negative, it's adverse. So, we've learnt something that we can apply. Oh yes, and I suppose we could add, getting slightly complicated here, these disappear under marginal costing. Okay? Then we look at our sales variances. We have sales volume and we have sales price. Sales volume, we said, was actual sales minus budgeted sales, multiplied by the standard profit margin. The price variance, we said, actual price minus standard price multiplied by actual sales. If you work them through, if it's positive, it's favourable. If it's negative, it's adverse. Keep it simple. And the only thing we have to remember, of course, is if we're looking at marginal costing, we don't value at standard profit margin. Instead, we value at standard contribution margin. So it's not too bad. It's rule-bound. It is very methodical. If you practice this and you learn the pro formas, bosh, you're going to score these marks. And that's great because you're guaranteeing yourself marks in the exam. Something that you can't necessarily do with some of the other topics. There is one final area before we leave this. The final area that we want to look at are our profit statements. Now, at this level, we're not going to get particularly excited about profit statements. But you may be required to interpret something that's already there. So all I'm going to do is give you a very basic consideration as to how you deal with them. Absorption costing on the left and marginal costing on the right. Now, I've called them profit statements, but what you often find them called is something called an operating statement. And what we're doing in an operating statement is simply this. We're attempting to reconcile from our budgeted value to our actual value. And the difference between the budgeted profit and the actual profit will be the sum of all the variances. There's an element of magic here, but don't worry about it. At this level, it's very difficult for the examiner to get you to do anything more than the simplest possible reconciliation. I'll try and give you a good pro forma. We start with our budgeted profit. And the first thing we do is we introduce our sales volume variance. You see, by introducing the sales volume variance, we are effectively flexing the budget. As such, we would add or subtract the sales volume variance to get our standard profit. That is the profit at the actual level of activity. Once we have that, then we introduce our sales price variance, and that gives us a subtotal. What we're trying to do is to separate the sales variances arising in one part of the business from the cost variances that arise in another part of the business. Once we've got the subtotal, then we include all cost variances. And of course, what we would want to do here is to list them down. Material price, material usage, labour rate, labour efficiency, and so on. And once we've got all our cost variances, yes, there is an element of magic about it. Hey presto abracadabra, we end up with our actual profit. If that's not magic, I don't know what is. Well, okay, that's the pro forma under absorption costing. Under marginal costing, we want to reflect the distinction between variable and fixed costs. So things are slightly different. We start with our budgeted contribution. Well, that's an interesting point. So we start with our budgeted contribution, and our first aim is to reconcile from budgeted contribution to actual contribution. Now, what is included in the makeup of budget and actual contribution? Well, we know contribution is made up of sales and variable costs. So that's all we introduce to begin with. We have our sales volume variance first of all. Plus or minus note, and that will give us our standard contribution. If you wish, and much more successfully under marginal costing, we can say we have flexed the budget. We have taken into consideration the difference between the budgeted level of activity and the actual level of activity. Then we look at our sales price variance. We add or subtract to get to subtotal. Yep, it is the balance with no name. All we've done is separated the sales from the variable cost variances. Then we can introduce our variable cost variances. Now, if you think about it, we've included all the variances to do with sales and all the variances to do with variable costs. Therefore, we have all the variances to do with contribution. We have now reconciled to actual contribution. But normally we go a little bit further because, of course, we still have our fixed costs. So, from this actual contribution, we would take away our fixed cost. And to do this, we would start with our budgeted fixed cost. But remember, when we're looking at marginal costing, there is a single variance for fixed costs. The only variance we have for fixed costs is the expenditure variance. So we have our single variance. That would give us an actual fixed cost, and we will definitely take that away to get to actual profit. Now, if I thought they were more important, I would dwell on them more. As far as I'm concerned, we know enough here, because any discussion about pro formas like this necessarily has to be very simplistic, because the maximum size of a question is 2 marks. As I've said already, variances are a great topic, but they need to be learnt. If you don't learn your variances, you won't be able to do them. If you do learn them, you will have confidence going into the exam. You'll be picking up guaranteed mark allocation. And more than that, when you get to F5, where you do a lot more with variances, you have a skill. And remember, having skills is so important. I'm hoping that given that you've done some study on F2 now, you're beginning to appreciate that with these little 2-mark questions, you've got to learn this and you've got to be able to bang out the computations very quickly indeed. If you can do that, you'll have no problem